Hey traders, this is Blake Morrow with Trader Summit, and I'm super excited to bring back on Danielle DiMartino Booth, CEO and Chief Strategist at Quill Intelligence. Good to see you, Danielle.
It is great to be here. Thanks for having me. We now go by a much shorter, pithier QI research, but I'm still the same firm.
Oh,
I think, we just passed our 9-year anniversary. So we've been doing this for a while here.
that's fantastic. And, based on the interviews that you do and the interviews that I watch, which happens to be quite a few of them, you can tell that you've been in the markets for a long time. You've been doing what you do for a long time, and you speak the truth, and you speak to most of us traders that are just trying to understand the macro environment. So speaking of which, let me ask you this. Today we got some economic data. We got Case-Shiller House Price Index. We got the Conference Board Consumer Confidence. What do you make about this data? Because it seems like the consumer is doing all right, considering inflation, pressures and where, all those pressures that people are feeling. Consumer seems to be hanging in there. What do you make of the data that we're seeing?
So I think you need to be really careful when you're looking at home price data. It usually reflects the world as it was 3 months ago, and kind of where we were coming into the peak spring selling season a few months ago. And there were a lot of hopes and aspirations at the time. Sellers were a little bit more reasonable and realistic in their approach to pricing their homes. Since then, I would say it's a little bit of a different world. People in the world of residential real estate are surprised right now that they're seeing inventory build as rapidly as it is. So you've got kind of a running count in the background of the number of American cities where inventory is higher than it was in 2019. And that's going to become very problematic fairly quickly, which is why you had more of a reaction to the consumer confidence data than you did to the housing price data. The housing price data is not problematic enough for the Fed because we know that housing is weakening enough that a year from now, we're going to talk about the risks of shelter disinflation and how heavy that could weigh on inflation coming down as quickly as it will be once we're starting to reflect falling home prices. And that's where we're headed, given the rapidity with which we're seeing inventory build. The flip side of it is, I think a lot of U.S. consumers are hoping they're going to be okay. It was interesting. Americans' view of the broad economy and about how businesses are going to be doing in the coming year have absolutely collapsed. But they're still kind of saying, but for me, I think things might be a little bit at risk, but still okay. And so we're in kind of the sweet spot where if my neighbor loses his or her job, we're in a recession. And I think most Americans, and I think most polls are telling you right now that the majority of Americans think that we are in recession, not heading for one. And I'm talking about mainstream polls. 52%, 56% of Americans think that we're in recession. But that's okay as long as you're just talking about your neighbor. But that old adage is, if your neighbor loses his or her job, you're in recession. If you lose your job, you're in a depression. And so we're not there yet. Job losses aren't widespread enough yet, but we're getting there. And specifically because CEO, CFO confidence is not improving, it's just kind of stuck in a range. That means we're not quite finished cutting costs. So this next earnings season, we're going to see yet another round of layoffs coming out of corporate America. And I think that we might be at the point where this is starting to affect more than just your neighbor.
So unemployment, just going into that can of worms right now. Unemployment's ticked up to 4%, and you're seeing those weekly jobless claims getting up to that. No one wants to see a 300 handle at all, but we're getting back up there where we were last summer, where it was around 260, 270, and we kind of pushing up against that. Do you think that the jobs picture is just on the cusp of turning a little sour?
That's what we're seeing. What we're seeing is, in a word, momentum.
Yeah.
And we're seeing layoff announcements arrive in months that are not typically, April shouldn't have had more layoffs announced than January. And yet that's what we saw in 2024. That was unusual on a seasonal basis. And when things begin to fall off their seasonal normal patterns, you always see joblessness rise in the summer. You know, Detroit shuts down its auto factories for a few weeks. And so you see a little bit of seasonality there, and a little bit of weakness into July. These are all things that we expect, but it's the broad nature of the layoffs that we're seeing. It's when a logistics firm in Humble, Texas, on a Thursday afternoon, via text, they learned that their company that was owned by private equity is closing, and you're not getting your paycheck on Friday, and it's only going to affect 2,000 employees. It's when things like that happen, which just happened, that you start to say, there's cracks in the edifice that are not just your normal ebb and flow of the business cycle in any given year.
Okay, well, that's a great answer. And I did want to go back to something that we were talking about, just about the Fed and how they're going to be affected by, or will they be affected by data? And a couple of our people in our community, they wanted me to ask you, how do you feel about the Fed, what's the realistic probabilities of them cutting in September as the market's trying to price in ahead of an election? Do you think that's even possible?
Sure, I do. I think that too many people on social media, it's so much fun to let's have a good solid hour of bashing. Let's bash the Jay Powell pinata, because it's so much fun. It's so much fun to liken him to his predecessors. Janet Yellen was afraid of going up on the Hill. She didn't want to talk to anybody in Congress. She didn't want to talk to anybody, period. Ben Bernanke was also, he was pretty shy.
Yeah.
And he wasn't politically shrewd. Alan Greenspan, different story. He liked to talk to people on the Hill, mainly presidents.
No one understood what he was saying, though. No one understood.
True, but he loved the limelight, and so Jay Powell is the exact opposite of all of these people. It's a matter of public record by law, but he has been to see more Congress people on both sides of the aisle than any of his predecessors. So he's been very active in speaking with people in Congress about what are your constituents seeing, feeling. And it's not to be political, it's actually to be the opposite of political. He was pointedly asked 2 press conferences ago, if the data weaken materially enough such that there's a justification for going in September, will it stop you that is the FOMC meeting that precedes the election? And it's rare that Jay Powell goes off script when he's up at that podium after the Fed meets, but kind of a dark cloud crossed his face, and he said, every meeting is live. Every meeting is live. Politics won't change that. So he's a different animal. And if we see, as we saw kind of as 2007 turned into 2008, we'd seen little baby steps in the unemployment rate, and it was inching up 1/10 at a time, slow. And then boom, came early 2008, and you saw big moves in the unemployment rate. If that's where we are in the July and the August employment reports, I could certainly see him having that first rate cut arrive in September.
Okay, and that makes sense. He definitely is on both sides of the aisle. He's very well spoken, and it seems like but he will get beat up by the social media.
He's going to get beat up anyway.
Of course,
and you know what? He's used to it, and the guy's background in private equity is worth $150 million.
Right.
He certainly does not have to be there to be the whipping boy, and yet he is. So
yeah, that's a great point. Okay, let's talk a little bit about macro. I was having a conversation with another economist who was just like, look, macro doesn't really matter until it does, to the markets anyway. And right now, the markets are oblivious to anything that's going on. And I think you could probably argue that it's ignoring a lot of the key signs. So how do you feel about the macro environment and the temperature of it right now, based on where the economy's at?
So, not in environments like these, when you basically have, 2000 and the year 2000 and the year 2007, walk into a bar, hook up one night stand. You've got just as much stock market overvaluation as you do over indebtedness. Well, corporate America, household balance sheets are just a terrain wreck. It's not mortgage debt, but right now the average American family is paying more in non-mortgage debt interest than they are in mortgage debt interest. Extraordinary times that we're in right now. But when you have this kind of a dynamic, that markets are overvalued. It's just something innate. You ignore most charts, except the one that says the top 10% of the stock market is now more concentrated than it's been at any time since. And you innately say since 2000, but that's not the answer anymore. Now it's since 1929.
Yeah.
So now you have my attention. You simply have my attention. Do stocks care? No. It's not until the Fed actually lowers rates, no jawboning, no, we're going to taper quantitative tightening, and none of that. When the Fed actually lowers interest rates, some stock jock on a trading floor says, "Oh, bleep, the Fed thinks we're in recession," and that's the only time you're going to get the attention of a stock jock. It's like, "Oh, bleep," and then it happens. And then it doesn't matter if consumer confidence falls out of bed and CEO confidence doesn't pick up. None of it matters until somebody says, "Get me an economic calendar. The Fed just lowered rates. What's happening here in the economy? How is that justified?" Because until then, you're going to stay long. It's just the way it's always worked historically.
So it's interesting you say that, because it's like, if the Fed says they're cutting rates because they want to bring rates closer to what they feel is nominal, versus, oh, I'm just trying to, I'm cutting off, we got slow growth, so I need to cut rates now. I mean, it's not going to matter in your view. They're going to cut rates, and the market's going to take notice.
If the Fed lowers rates in September, and then the stock market does what it's always done when the Fed cuts rate and falls out of bed, they're going to say, "He's trying to throw the election."
Yeah.
It's by design. And Jay Powell will probably be like, or the unemployment rate went up. Boom. The unemployment rate in May was already at our year-end target of 4.0%. 7 months early. Are we paying attention? Yes, we are. So, but nobody's going to speak that logically about it. Nobody will be that sober about it. My Twitter feed will just go like a mushroom cloud of, "I told you he would bend over for anybody." And so it's going to be what it's going to be.
Right. Okay. Well, I want to ask you one last question, just because, it's been a while since we've talked, but the last time we talked, and I've listened to a lot of your interviews, you've been really, really bullish precious metals, gold, and it's just been a great call. Obviously, we've been to new all-time highs, but I love the fact that you are Texan, and I lived in Dallas for 11 years. So I'm, very, very familiar with Texas folk, and you are a straight shooter. And I know you get a lot of calls, you get a lot of texts from people that know you're in the industry. What do you tell your family and friends that might be a little bit too aggressive along risk, if you will? What are the conversations you have with them, and what are you telling them right now? I know it's a difficult question.
So it's a really difficult discussion to have right now. I mean, you can't have, "Hey, I'm sitting around the pool" conversation with somebody who's pondering, "Hey, I'm going to turn 60 years old soon. And, I'm looking at, forward to my retirement years. And I mean, just, where should I be right now, Danielle?" And I'm like, well, that depends on if you're serious about that retirement thing and, how exposed you are to the stock. Well, I've got it all in the stock market. What are you talking about? Well, oh, okay. If you're 100% stocks, we should talk about retirement again. Oh no, it'll come back in a few years. And I said, well, these cycles don't dictate their length. We just know what happens at certain times. And, you're in the mortgage industry. Oh, things have really slowed down. Okay, good. Now you understand the economy is slowing. You can see it with your own eyes. So, we go round and round. And what as gingerly as I possibly can, a few months ago, I was like, "You still own Bitcoin? Why don't you take that off the table and just plop it into the queues?" Because the unemployment rate's not where it needs to be for the Fed to lower rates just yet. So if why don't you take your gambling money out of Bitcoin and throw it into the NASDAQ just for fun and let it ride. As far as the rest of your actual portfolio goes, for the love of God, I don't think now is the right time to have it in the stock market if you truly want to retire in 2 years.
Right.
So if that's, again, it's all a matter, would I say the same thing to somebody who is 30 years old? No, I wouldn't. But where you are in your career is really critical at times like this, when there's a chart floating around that says we can only compare current market concentration to 1929. I mean, those are things that should get your average Joe's attention if they had any civics in high school.
Sounds good. You know, I think you forgot the last part of your conversation had been, you know, I heard this service, this QI Intelligence. You should check it out. Speaking of which, Danielle, I love having these conversations with you. And I know how to follow you, but I know not every trader does. So what's the best way for us to follow your work?
So if you don't already, and you want to come yell at me on Twitter, please, at DiMartino Booth. And QI research, I am told, is a stupid, dumb price, too low. It's an institutional product that we call retail. That's because I've never wanted anybody to not be able to have access to my thinking after Fed Up was published. So DiMartinoBooth.substack.com. Come see what it's all about. A lot of our institutional clients, you know, they read the takeaway in the morning, 3 bullet points. They look at the 4 charts and they're like, oh, okay, check. She's still smart. Move on. And that's how it goes. But I'd love to have any of your wonderful acolytes as subscribers any day.
Well, Danielle, it has been a pleasure to have you here, and I look forward to future conversations with you. And make sure, if you all have any comments for Danielle, jump down in the comments below. Give her a big thumbs up too. And Danielle, thanks for joining us. I will be talking with you soon.
Thanks. Take care. Good to be here.
You do the same. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.